Ladies and gentlemen, welcome to a conference call surrounding a topic that I think is of interest to many of you, that is gold and gold-related securities. I'm delighted to be hosting this call, and I'm delighted more to host our panelists. Brien Lundin of Gold Newsletter and the famous New Orleans Investment Conference, Doug Casey, a long-standing spokesman for the gold cause, and in particular, my younger friend, Nick Hodge, who can talk about gold and gold stocks in the context of much broader investment portfolios because of the broad range of investments that he covers. I'd like to begin this discussion, I think, by asking Doug Casey to do as he has done for 45 years and enumerate in abbreviated form the historical advantages of gold ownership and the case for gold, which, as he points out, goes back at least to Aristotle. Doug?
Yeah, thanks, Rick. Gold is a unique financial asset. The first thing I like to say about it is it's the only financial asset that's not simultaneously somebody else's liability. So you don't have to trust anybody else. It simply is what it is. It's one of the 92 naturally occurring elements. And as Aristotle pointed out, it's uniquely well qualified for use as money because just like aluminum is good for building airplanes and uranium is good for nuclear reactors, gold has physical properties that makes it good for money. So that goes without saying, although it's odd that increasingly over the last 40 years, gold has been demonetized. But that's going to change. I'm of the opinion that within the next generation, that gold is once again going to be used in day-to-day commerce and is going to actually be the currency or back major currencies. So I'm bullish on gold, even though at $1,300, it's not a giveaway bargain the way it was in 1971 at $35 or in 2002 at $250, when in real terms it was actually cheaper than it was in 1971. But you've got to buy it. So that's kind of my presentation in a nutshell.
Brien, moving on to you. Your life is probably more wrapped up in gold than all of the rest of ours, given that your primary business is Gold Newsletter and an investment conference that for 40 years has focused more than anything else on gold, going back to when the name of the conference was, in fact, around the National Committee for Monetary Reform. In other words, your conference was originally formed to legalize gold. What I'd like you to talk about now is the state of the, not gold stock market, but really physical gold market now as compared to other points in time in your career. Its popularity, that type of thing. Tell me what you feel about the physical gold market that we're in right now.
Well, Rick, a mild correction. This will actually be the 43rd annual New Orleans conference. And you know, an event of that stature that's gone that long has seen many cycles. And you, better than I think anybody else in this market, has a deep appreciation for the cyclicality of not only commodities, but in particular the gold market. You know, we've seen a lot of booms, we've seen some busts, and especially the New Orleans conference. I mean, it's always a wonderful event to go to, and obviously I highly recommend it. But there are certain times when the New Orleans conference really shines, where it really has just tremendous utility. And that's at the beginning of these major cyclical upswings in the metals. And relating that to where we are now, you know, we went through a nearly 5-year bear market in gold from the peak in the summer of 2011 down to December of 2015, and we've come up from that low. We've got about a year and a half, almost 2 years off of that low behind us. So this reminds me, looking back at the cycles of the 2001, 2002 time frame, when it was obvious that gold was on the upswing. the easy, the cheap, the stupid money had been made, and that anyone who had actually invested in just a basket of junior stocks and mining stocks had seen their investments double already. So a lot of people were a bit skeptical and hesitant now, thinking the easy gains were gone and what now? But in fact, the people who invested at that point in time saw the vast majority of the gains. As you know, there were stocks that went up 5, 6, 10 times over, and even more, over and over during a 9-year span from that point on. And in different sectors, we had uranium, we had rare earths, we had precious metals, but there just were tremendous gains made by people who got positioned at that point in time. And that's where I think we are now. That's why I think this is just a tremendous opportunity, and especially to get all four of us together to talk about that opportunity, because the timing is perfect. We've had a brief lull in this new gold rally, and some people are starting to doubt it. But in fact, I think it's an opportunity to find some bargains.
Nick, you're our token generalist here. I want you to answer two questions for me. With gold and gold-related equities accounting for about 1/3 of 1% of the savings and investments of Americans, why would anybody care about gold? And for somebody who makes his living publishing a newsletter, why would you focus on a sector that nobody cares about?
Well, I think that the fact that so few people have money in gold is actually a bullish notion. The gold market is so small compared to the rest of the world equity market that it doesn't take a lot of money flowing into the sector to make not only the price of gold rise, but the price of associated equities. And then, of course, you get the leverage that junior gold companies provide. So I think that Americans are mistaken in only having 1/3 of 1% of their capital in gold stocks, and I think it takes a very small amount of new capital coming in to move the needle. And I truly think we're heading into that period now. I think not only do gold majors need to reinvest to shore up their reserves, so they have assets to produce down the road because they're quickly depleting their assets that are in production. But I also think that it's one of the few safe havens, as Doug pointed out, and has been the mantra of the New Orleans conference for the past 42 years. And that's the notion is that it's something tangible that you can hold in your hand. I look at some of the other things that are going on in the financial market. Take like the Snapchat IPO, for example. $3.4 billion were raised in that IPO. Which didn't go all that well, and it's really based on a product that disappears. It's a text message that disappears 3 seconds after you send it. Those aren't the sort of things I like to put my capital into, and gold presents an opportunity to invest in something real. And then to answer the second part of your question, that's why I write about it to my readers, and that's why I tell them they have to have a portion of their investment capital in not only physical gold, but in gold equities as well.
Nick, I'd like to... I'm sorry, go ahead, Brien.
You're alluding, you and Nick are alluding to the potential that the gold market offers if just a fraction of the money that's allocated right now in equities and bonds is shifted into gold. And it's just, I find it funny that we have the gentleman on the line here who I think had the seminal statement of all time on that potential. Doug, would you like to repeat that, or do you know what I'm even talking about?
The Hoover Dam reference.
Dam reference.
Yes.
Yeah. Where will I start on this? It's that having been involved, and we can go back to what you said, Brien, because I'm not sure exactly which timeless words you'd like me to reference again.
I think it's the Hoover Dam reference.
Doug.
No, having watched what's happened to not just the gold markets, but the financial markets in general, and for that matter, Western civilization and the direction that it's taken for the last 40 years, this is a superb time to buy the metals. I think there's going to be, before this is all over, a buying panic into gold. Most of the financial markets right now are in bubbles. The stock market is in a genuine bubble by the many, many parameters that we can define that. The real estate markets of all major cities in the world are in a real bubble. And worse than that, the bond market is in a super bubble, a hyper bubble. And eventually all bubbles pop. So where's the capital that's in these things going to go? And I think it's going to go into gold, because gold is the numeraire, and the real sickness in the financial markets is based upon the monetary system, where money is being created literally out of nothing by these central banks. It's going to end very, very badly, and I suspect it's going to end this cycle, because the analogy I like to give is that we went into a gigantic financial hurricane in 2007, and we've been in the eye of the storm since 2010, but now we're going to go into the trailing edge, and it's going to be much worse and much longer lasting and much different than what came before. So where are people going to put their money? And I'm forced to believe it's going to be into gold.
Well, thank you as always for those comforting words, Doug. I'd like to return.
Rick, I'm toning it down to public consumption.
I'd like to return to the youngest member of the panel, Nick Hodge. You know, Nick, one of the ways I amuse myself is by communicating with a lot of younger people, in particular young members of Students for Liberty, a worldwide libertarian organization. And several of them have taken to reminding me unnecessarily of my age and suggesting to me that my fondness for gold is really a function of my generation, and that in fact cryptocurrencies, in particular Bitcoin, obviate any sense in either investing in gold and speculating, or speculating, pardon me, in mining stocks. In terms of gold, they say that the anonymity of Bitcoin and the fact that it's a non-government sponsored currency and the efficiency by which it trades obviates gold as a medium of exchange. And with regards to the junior cryptocurrencies relative to the junior mining stocks, they say that the efficacy of the cryptocurrencies is demonstrated by the fact that they go up, while the gold stocks seem to go sideways. Nick, is the blockchain, are cryptocurrencies, and in particular Bitcoin, substitutes for gold and gold mining stocks?
I don't believe they are. I believe they're complements too. And I will tell you that I've experienced some of the same things that you're describing. For example, in our publishing offices in Baltimore, there's approximately 40 employees, 2/3 of which are under the age of 25. And I can tell you for all of 2017, these kids, I call them kids, they're not many years younger than I am, but these kids have been talking about and trading Bitcoin incessantly, and talking about it incessantly. And when I ask them, do you have your IRA set up, or do you have your retirement accounts funded before you're speculating on cryptocurrencies? And they say, no, they're putting any free cash they have into cryptocurrencies. And so there is a generational gap there, in that these kids have been brought up on digitized and computerized machines, and so a cryptocurrency seems natural to them. I would say that cryptocurrencies have only been around for half a decade or a decade, whereas the monetary value of gold has been around for thousands of years. And so while they think there's a generational gap, I think they're forgetting about a much longer history there. And so I don't think cryptocurrency replaces gold. I think it's temporarily distracting some attention away from gold, but it's certainly not a substitute to the a physical metal that you can hold in your hand. Ultimately, we're still talking about ones and zeros. Just look at things that have happened recently with the Yahoo hack and the Equifax hack. Don't think for a second that those same vulnerabilities aren't apparent in cryptocurrencies like Bitcoin and Ether. So I just think they haven't been around enough for this younger generation to learn their lessons. And when they do, I think you'll see some of them become more interested in gold.
Excellent point. And let me follow up on that, because you're quite correct. And one of the many good things about these cryptocurrencies, and I'm all for them incidentally, is that they are inevitably going to draw attention to gold. Because when you buy Ether or Bitcoin, what you're saying is, I would rather have Bitcoin as a currency than the dollar. And the thing is that 3/4 of the people on this planet live in countries that use currencies like kwaches and pulas and matakas that are worthless outside of the country that issues them, and not worth much in the country. In fact, those poor people, if they try to save those currencies, they're on a Sisyphean treadmill. So the whole world, the whole third world, 3/4 of the world's population is going to go to Bitcoin just to avoid having to use those local currencies and to allow them to get their capital outside of the country. All of these things are going to draw attention to gold for the reasons that you mentioned. It's the ways that it's better than these currencies, but these currencies are the Bitcoin and Ethereum are drawing attention to the faults of the current monetary system, the problems with it. So they're very good for gold.
And Doug, I think they'll eventually draw attention to the faults of every monetary system that's not founded on gold, and that it's subject to human nature and greed, and will eventually depreciate. You know, these currencies do depreciate by the fact that there are new currencies invented virtually every day, and then the ones that exist will fork into two, et cetera. So they will be depreciated, and but their utility will, as you say, draw attention to gold. And I think the blockchain technology, as we're seeing, will be applied to gold ownership. And I think that's going to be just a huge source of increased demand for the metal.
Well, I'm glad you mentioned that, Brien. Never one to pass up the opportunity to advertise. Sprott has a substantial investment now with the IEX people, the flash trade boys, on using blockchain technology to create a gold token that would in fact clear and settle through distributed ledger, but be backed by and exchangeable for physical gold, something that I look forward to discussing with all of you at the upcoming New Orleans conference, which I think is a great forum. I'd like to move on a bit, though, having delivered my well-timed advertising. You know, one of the things that amuses me when people talk about gold is the fact that it hasn't performed. And I think you need to pick your starting date. My starting date, when I became familiar with it, was in the early 1970s, when I first had some savings. And when I look back, in that period of time, gold has gone from $35 to $1,290. Not a bad performance. If by contrast, I choose a little more recent date, say the year 2000, gold has moved from $260 an ounce to $1,290. Not a bad performance. If I take it back just a year and a half, gold has moved from about $1,100 to $1,290. Not a bad performance. Certainly if I take myself back to the beginning of 2011 when gold was at $1,900 and now it's moved back to $1,290, that performance is not so attractive. But I'm interested in people's perspective. If the point of gold is to maintain one's purchasing power, certainly through my lifetime, it's done substantially better than that. And if we look at the past 2 decades, gold has done that as well. I'd like to ask each of the panel briefly whether, although maybe you have aspirations for a higher gold price as a consequence of what you do for a living, whether or not you have been disappointed in gold's performance relative to its your expectation for it in your portfolio.
Well, I'll speak to that. You've got to recognize what gold is. It's money in its most basic form. And what is money? It's a medium of exchange and a store of value. Now, gold has been also a speculative medium since it was decontrolled by the U.S. government in 1971. But it's basically a store of value. So, and that's basically the way I treat it. If I want a speculative medium, and I think it's reasonably priced right now, going higher in real terms, but reasonably priced. If I want a speculative medium, then I look at these mining exploration stocks, which are the most volatile class of securities on the planet. So you can have it both ways, stability and safety, by owning the metal, and speculative upside if your timing is good. And right now it is good if you get into them with these mining stocks, which even as a class go up 10 to 1 altogether, with some examples going up 100 to 1. I've personally been involved in a couple of stocks that went up 1,000 to 1, as I know you have, Rick.
Brien, moving on to you, taking your marketer's hat off, which I realize is hard, and talking about gold as an asset class, has its price performance disappointed you?
Well, Rick, I try to divorce myself from the day-to-day meanderings of the gold market, and not always successful with that. We're all involved in it, and it tends to get emotional, and you do tend to pin your future hopes on, especially me, on where the gold price goes. But getting back to what Doug said, at its most basic form, gold is the counterbalance to the world's fiat currencies. And given the levels of debt that have been built up really since the 1960s and 1970s, when the world as a group basically went off the gold standard, those debts, and particularly the ones since the 2008 crisis that have been built up, they can't be addressed by growth, by tax cuts, by spending cuts, by tax hikes rather. There will be a significant amount of currency depreciation necessary to be able to address those debts. And that makes much higher gold prices virtually inevitable. And it also illustrates the need for gold as insurance. But like Doug, I'm looking at the opportunities more near term that these junior mining stocks offer. I think we're at a real turning point for that sector, and that all we really need are steady to consistently rising gold prices to get a level of excitement and speculation going in that market where companies can raise money, they can start exploring, and they can start making discoveries. And we're seeing that right now. Just over the summer, we saw some companies make some big discoveries. And what I'm looking forward to doing is telling people who, in a couple of weeks, who come to the conference and through our newsletter, of some of the opportunities I'm seeing, and discovering some of the ones you guys are seeing of companies that are exploring right now and on the verge of really making big news and big advances in their market caps.
And Nick, how about you? Has the gold price performance disappointed you as a generalist investor? And do you think it has served its purpose in the portfolios of your subscribers?
Do I think gold prices should be higher? Yes. Have I been disappointed in their performance? The answer is no, especially when taken in context of all the unprecedented monetary actions that have been taken by central banks across the globe since 2009. I'm looking at a year-to-date chart right now, for example, and you have the S&P at all-time bubble highs, stoked by share buyback plans that have been driven by access to cheap capital. And even at all-time bubble highs, the S&P is up 13% for the year. Nonetheless, gold is up 11%, and it is not the benefactor, at least yet, of all that unprecedented monetary action. Though, as Doug said earlier, it will ultimately be the benefactor of those actions. So, no, I don't think it's been disappointing. And also, if you're familiar with the sector, you'll be familiar with the cyclicality of it. And so, we've had to deal with $1,000 and $1,100 gold over the past 5 years, but there still have been opportunities if you're looking at producers with the lowest quartile cash costs, or developers with projected low-in all-in sustaining costs and high RRs, internal rates of returns, and higher projected net present values. Then there's been plenty of opportunities if you're willing to roll up your sleeves and do some typing in an Excel spreadsheet. So, I'm of the opinion that the market is right. And so if the gold price has been what the gold price has been for the past 5 years, then the market is right. But like you gentlemen, I too see a very real bull market in metals coming, led by the very factors that have caused gold to underperform the market over the past 5 years.
In one of my workshops in the upcoming New Orleans conference, I'm going to make the proposition to the attendees that most of what has been wrong in the gold equities market in the last 40 years has been the fault of investors, including investors like myself. I'm going to argue that our paradigm, our expectation of the future, was set in the 1970s when the gold price ran from $35 an ounce to $850 an ounce, when the attribute that paid the best was leverage to gold. I'm going to argue further that, of course, the least efficient companies are the most leveraged. And as a consequence of that, investors, including myself, asked the companies to exhibit leverage to the gold price, which is to say that we asked them to be marginal. And they became extremely marginal. The gold mining industry and exploration industry, taken as a class over 40 years, has destroyed capital at an absolutely amazing rate, and only exists as an industry because the top 5% of the companies have exhibited so much skill in adding value that they've added legitimacy and in some cases luster to a horrifically bad industry. I'm going to argue further that what is unique about this cycle is that we are beginning what I see as a corrective phase, where investors are asking the companies to become efficient and give leverage to the gold price as icing on the cake rather than the reason for existence. My supposition is that the recent moves, as an example by Paulson and Company, to form a coalition, an informal coalition of gold equity investors to weigh in on corporate governance, is the beginning of an investor-led renaissance insanity in the gold mining industry that will cause the gold mining stocks to outperform the expectations of even some of the loyalists. And I would ask my co-panelists, this time beginning with Brien, to comment on expectation and performance in the gold equities business.
Well, Rick, I have seen your comments on this in another interview or two recently, and I have to say it's really brilliant. I think you make a remarkable insights into the nature of the market and the history of the market. As you know, back in the 70s, the South African mining stocks that Jim Blanchard, who started the New Orleans Conference and Gold Newsletter, used to speculate with, and from which he built, played a large part in building his fortune. The whole idea then was to have companies of huge reserves and barely profitable, if profitable, production. So their balance sheets just exploded as the gold price rose. That creates the cyclicality in the gold market. That creates the highs and the lows that smart speculators can actually profit from. So I have to say I have mixed feelings about trying to reform the industry and get away from some of that cyclicality, because that's where, if you really are on your game and you look for companies that are at extremes, either high or low, and act on those, then you can really make the big money. And I do think for shareholders who are long-term shareholders, it is a good thing. I think it can be taken too far if a company like Barrick did in the 90s, when they hedged in the early 2000s, had much of their production hedged and showed very little leverage to the gold price. But then again, there's leverage on the price and there's leverage on growing production as well, and a well-run company positions itself for that as well. So I think it'll be interesting. I think it's a worthy cause and a good point. But I probably don't look to the reform with as much fondness as you do.
My only comment to that, Brien, would be that in the period 2000 to 2011, the gold price went from $260 an ounce to $1,900 an ounce, and free cash flow per share for the industry as a whole declined. That took a special skill set, I think. Doug, perhaps you could comment on the attributes that you think are appropriate in gold mining stocks.
Well, Rick, as you know, I've disliked the industry as an industry for many years. I call the gold mining industry a 19th century choo-choo train industry where people go out and play around in the dirt with big yellow trucks. And interestingly, all over the world, people have been looking for gold for thousands of years. And it used to be you could mine gold, you could only mine gold if it was about an ounce per ton. Now, they're mining gold where it's a fraction of a gram per ton. So as an industry, as a business, I think it's a terrible business. You have to spend many, many millions of dollars to find the deposit. And then if you find it, your trouble really starts with the permitting and the drilling out and the NGOs that are going to try to screw you up and everything else. So I see gold mining as a speculative thing. It's not something you can invest in the way Warren Buffett does for growing earnings. That's why Buffett never invests in these kind of stocks. So that's the bad news about the mining industry. But the good news about it is there's who knows, I don't know, maybe nobody knows, a couple thousand companies in the world that purport to be gold mining, exploration and mining companies. Most of them are crap. But if you do a little bit of research and you hook up with the right people, which is one reason I always go to the New Orleans show, because it's where everybody who is anybody goes and you can meet them and talk to them and size them up. You can get on a playing field which is not level, but is tilted in your advantage. And I don't like to be on a level playing field, especially when I'm dealing with a dead duck industry like gold mining. That said, all these nasty things I've said about the gold mining industry, adding to the nasty things you've said about it, Rick, and we're both correct, this is a fantastic time to get into these things as speculative vehicles with huge potential. I'm not talking about doubling your money. I'm talking about much, much more over the next cycle. I'm quite sincere when I say that.
Nick, you follow various industries. Do you think that the gold mining industry becomes more attractive if the companies are run as businesses, or should they continue to be, to paraphrase one of Doug's old speeches, trading sardines rather than eating sardines?
Or burning matches, I think he's called them as well.
Yes, both are accurate.
No, I wholeheartedly welcome the call from Clausen and Company to create a coalition of shareholders of gold mining companies to put a more close eye on the management. As a fairly newcomer to this industry, I've done a lot of research and talked to a lot of people, so specifically at the New Orleans conference, and I tried to get to the bottom of every industry I uncover because, as you say, I'm a generalist, and I must say that, Trump talks about draining the swamp in Washington, but there's a swamp on House Street as well, and it has to do with, the way companies are financed and how the shares are held. And, at talks at New Orleans and elsewhere over the past couple of years, I've made it a point to advise retail shareholders that are interested in junior mining companies that, share structure is ultimately the most important thing. There's been too many gold juniors and other metal junior companies over the years that are run as lifestyle companies where they're, taking capital from shareholders to run their lifestyles as opposed to create a real company as opposed to putting the money in the ground to create shareholder value. And I think it's time to pull back the curtain a bit. And so I welcome that call, to be honest.
This whole discussion has reminded me of a circumstance, wonderful circumstance that happened to me, I suspect in 1990. At the New Orleans Investment Conference, Jim Blanchard introduced me to a wonderful gentleman who's still a close friend, Adam Fleming. And the consequence of meeting Adam Fleming is that I went to Johannesburg and then London and met with him twice more. And the consequence of that is that I became involved in a scheme to reorganize an inefficient South African gold junior called Consmine. Useful in this conversation because this was a company that was not being run for the benefit of its shareholders. But as a consequence of that, the shareholders changed. Useful also because for people who held Consmine and the successor shares through 7 or 8 years enjoyed the 100-fold, not 100%, but hundredfold return that Doug talks about. But then also useful in this conversation because one of the companies that came out of Con's mind indirectly was Randgold, the Mark Bristow company, that has demonstrated that through good markets and bad, not just in speculative highs, that by doing certain things more efficiently than other people, exploring more efficiently, having lower general and administrative charges, building operations more efficiently, and importantly in Africa, hiring Africans to run the operational roles in countries, that your share price and your returns on capital employed can substantially outweigh the median, and the means. I guess part of this statement, Brien, is the hopes that you'll be able to introduce me this year or next year to another Adam Fleming, but also to point out the extraordinary returns that can come to investors who participate in face-to-face meetings in these conferences and then pay attention and implement the knowledge that they've learned, and implement that knowledge not just in the 90 days that comes after the conference, but in fact in the entire decade. Had I not stuck with the lessons I learned from Adam Fleming and other people that he introduced me to in South Africa, I might have traded Con's mind for a double and left most of the move, remember, a hundredfold move, on the table. Anybody want to talk to that?
Well, Rick, I'd like to, just because you mentioned Adam Fleming, who's just a true gentleman and, one of the last remaining hardcore gold bugs out there. But I don't know if there's another one of him, but there are similar opportunities out there. And we've seen that at the beginning of every major upcycle in the metals and at the New Orleans conference. We saw that in the early 90s, as you remember, in the complete reorganization that Adam and Mark Bristow did with Randgold and getting that calcified South African mining industry to actually revamp its domestic operations, but also look further afield in Africa, which is what Randgold did so well. But we saw that in the early 2000s. Again, going back to that era is an analog to where we are now. Some of the best companies out there, junior companies, mid-tier companies right now, were created in that era. We saw companies like Altius, we saw Nova Gold, we saw Northern Dynasty, some of these on exploration, some of these based on a new business idea, business model. And these companies rewarded their shareholders, again, with 10, 20, 30 time returns as they built up in an atmosphere that was very conducive for that with rising metals prices. So I know that we're going to see similar opportunities emerge in this period, and I'm looking forward to finding some and exposing our attendees to some at the conference in a couple of weeks.
I'd like to throw out one more theme that I think has been under-commented on with regards to our industry, and that is the fact that I personally believe that we're coming into an exploration bull market. The industry, both the majors and the juniors, have underinvested in exploration from my point of view since the middle of the decade of the 1990s. And the consequence of that is that the development pipeline that the industry faces is severely constrained. I remember the bull market that we enjoyed in the 1992 to 1996 time frame as being the single most explosive bull market of my career, including the bull market of the 1970s. I don't remember a period of time where I got equity performance that rivaled the performance that I got in the early 1990s at any other point in time. And I think I'm going to make the argument in New Orleans that unbeknownst to most people, we're coming back into an exploration cycle. Witness, as an example, very recently, Novo, which thus far, without a drill hole, has gone from admittedly a brilliant geologist and a wonderful story, and I'm not criticizing the company. It's gone from a $30 million market capitalization, pardon me, to a market capitalization, including in the money warrants, of $1.5 billion. It seems to me that we are in the throes of a market that will respond to good discoveries in extraordinary fashion, in the same way that the early 90s markets, which of course gave us the great diamond discoveries, that gave us Arequipa, that gave us all those spectacular discoveries, of course Diamond Fields. Anybody have any comments on that observation?
Sure. You know, I think I said it earlier that the majors need to replenish their reserves. They've gone from a peak of having 27 years of reserves on hand to just 18 now. And so in a very real way, they're going to have to get out there and start, you know, replenishing those reserves, whether that's buying outright junior exploration and development companies or partnering with them to fund a portion of their activities. And I think we're seeing activity pick up on that front right now. We're seeing some brown fields being resurrected, some mines that became uneconomic in the 1990s being resurrected. And I think that trend is going to continue, not only with brown fields, but I think you're going to see some real bull market prowess in the green fields as well. And that hasn't quite started to pick up yet, but I think that's to follow. And so if a disproportionate amount of gains in a new bull market come early on in the cycle, then now is the time to be positioning yourself in those exploration stories that are going to heat up as these majors have to really dig into their coffers and start spending some money to replenish their reserves.
And you know, Rick, go ahead, Doug.
I totally agree with what said, and we've been in a commodity bear market, not just gold coming from $1,900 down to $1,300 since 2011, but all commodities have been in a 50% sell-off bear market, and they're the only things in the world that are cheap right now. Stocks, most stocks, bonds, real estate, they're at hypey levels. So commodities and gold are the only things that are cheap right now, and these mining stocks are very, very cheap. And my guess is before the bubble breaks in the overall stock market, there's going to be money that flows into these mining stocks, especially as gold starts moving up in recognition of the points that you guys have made. So I think we could be looking at a fantastic bull market in junior mining stocks over the next few years.
Yeah, and to add to that, I really agree with you, Rick, that this is an exploration market we're getting into. And in particular, at this very moment, there's a quirk of timing that I think benefits us in that 2016, we were coming off the bottom. All of a sudden, these companies that had been in an industry that had essentially been dormant from 2012 through 2015, no money was being spent, no money was raised, hardly any money was raised. But all of a sudden in 2016, as the gold price and silver price recovered, they were able to refill their coffers, put money in the treasury, and get back to work on the projects that had just lain fallow for those years. And now, this summer and this fall, we're starting to see these projects really get concerted drill programs, some really outstanding projects that have just been sitting around. They're essentially discoveries that just need to be followed up on. So we're getting drill results coming out for a number of companies. We saw GT Gold was a huge success this summer as well, and there are other companies in the area, and I'm going to reveal 3, 4, or 5 other companies that I think are in similar positions that are have what I would term unappreciated discoveries or on the verge of big discoveries, and with results that will be coming out over the coming months. These, I think it's just an enormous opportunity right now to find these still undiscovered, still undervalued exploration plays.
Gentlemen, I'm going to suggest that the best investments of all, better than gold, better than Bitcoin, better than stocks, better than bonds, is one's own education. Knowledge is something that can't be stolen. Maybe in my case and Doug's it can be lost over time, but only gradually. In fact, that working on your knowledge and your education and also your contacts has the highest return on capital employed and the highest return on effort of anything that you can do. I would like to urge the New Orleans Investment Conference attendance as an investment in one's own knowledge. This will be my 30th year of appearing. I like the conference enough that I obtain a fair number of seats and actually give some of them away to my finest customers, which says something about my regard for the conference. I look back at circumstances like the Kahns Mine circumstance. One thing that was nice was making the investment return. The second thing that was nice was expanding my range of contacts to include people like Adam Fleming. But the most important part of the entire experience was learning how money is made in business and equities markets. In fact, the experience. So I would like the listeners of this call to consider the New Orleans conference as an investment in their own education and paradigm. And I'd like to end the call by asking Brien Lundin, who is of course the promoter of the conference, to make attendance as attractive as possible. Brien, tell us specifically what you're going to do for your attendees and why they ought to be there.
Well, as you know, Rick, we have a long tradition of drilling down from geopolitics, economics to every asset class. So we have, the typical big-name speakers that you won't find at any, I say typical, the atypical big-name speakers you won't find at any other retail investment conference. We have the geopolitical people like Tucker Carlson, Jonah Goldberg, Stephen Hayes. We have people like Robert Kiyosaki, who has an extremely large following. We have people like Doug Casey, who tend to split our audience in half, 50-50, each side with equal fervor in their regard for Doug. But, we also have all of the top experts in metals and mining shares. True to our legacy as being the event that in the organization that helped legalize gold in the first place, it's always been the backbone of our legacy and of our event. So this is where you come to learn about these opportunities. And it's also the chance, getting back to your education, to learn not just from speakers. I mean, you just don't hear these speakers. You get to mingle with them in the halls and talk to them, buy them a drink at the bar. You get to look at these mining companies, go talk to management, look them face to face and ask them the tough questions. And you also get to, and I think this is probably the most important aspect or benefit of the event, is you get to mingle with other investors who share the same interests, curiosities, who have experienced success in this area, who are still eager to learn. And there's a level of intellectual energy in the halls of the event that I don't think you really see anywhere else. And that's why we really strive every year to burnish the legacy that Jim Blanchard created for all of us. It's an event that's designed for the attendees, and I think that's obvious from the moment they step on into the halls and see what we do for them. And that's why people come year after year. And getting back to the particular timing, although it's always a good thing to come to the New Orleans conference if you're a serious investor, I just think this opportunity right now, this opening in the markets that we see, is what the New Orleans conference is really made for, where it really shines and presents opportunities that you only really get to see a few times in your investing careers.
I'm delighted to hear you suggest that the attendees buy the speakers a drink in the bar. I know that Doug, Nick, and I are always open to offers in that regard. Listeners to the call should bear in mind that the conference takes place in New Orleans, Louisiana, between October 25 and 28 inclusive. There are details about the conference at neworleansconference.com. If this call hasn't succeeded in whetting your curiosity, I'm certain that the website will do so. And I'd like to take this opportunity to thank the gentlemen who were participants in this call and also the entire listening audience. And I genuinely look forward to continuing the discussion during the conference and maybe occasionally after the conference as you buy us drinks in the bar. Thank you very much.
I'll second that emotion, Rick.
Thanks, everybody.
I very much look forward to it. Thank you guys.